Welcome to Corelogic's update on housing market conditions for June 2019, brought to you by First National Real Estate. We saw a variety of outcomes and announcements through the second part of May and into early June that are likely to bode well for the housing market, including stability in the federal government, an announcement from APRA that borrower serviceability assessments were likely to improve by late June, and the RBA cut interest rates to a new record low on June 3rd. All this good news wasn't enough to stave off a further decline in dwelling values in May. However, market sentiment does seem to have improved over the second half of the month. Although dwelling values fell in May, the pace of decline continued to ease off, a trend we've been seeing since early 2019. Nationally, dwelling values were down 0.4% in May, which was the smallest month-on-month decline since May 2018. This improvement is primarily being driven by a slower rate of decline in Sydney and Melbourne, where housing values were previously falling at the fastest rate of any capital city. Sydney values were 0.5% lower over the month, while Melbourne values were 0.3% lower. That's the smallest decline in values across both cities since March last year. In other cities where housing market conditions have generally been more resilient to a downturn, the trend is the opposite. Hobart values have tracked lower for 2 months running, taking the rolling quarterly change in values into negative territory for the first time since early 2016. And with Canberra values 0.2% lower over the month, the quarterly rate of growth remains only slightly in positive territory at 0.2%. While the pace of value falls has eased across some cities, the Australian housing market remains in a geographically broad-based downturn. Adelaide was the only city to avoid a slip in housing values over the month, and in the rest of state areas, South Australia, Tasmania and the Northern Territory were the only regions where values rose in May. In fact, regional Tasmania is the only broad region across the country where housing values remain at a record high. The slower rate of decline is also visible in higher auction clearance rates through the month. The last week of May saw Sydney clearance rates break the 60% mark for the first time in a year, while Melbourne clearance rates have held around 60% over 3 of the past 6 weeks. Although clearance rates remain low relative to several years ago when housing market conditions were much stronger, the improved performance at auction aligns with the easing rate of decline. Since peaking in October 2017, national dwelling values have reduced by 8.2%, with values across the combined capitals down 10.1%, while regional values have been more resilient, falling by 3% since peaking. Larger capital city falls have been recorded in Darwin, which is down nearly 30%, and Perth, where values are down by 19%, as well as regional WA, where the mining downturn has led to persistently weak economic and demographic conditions that have weighed heavily on home values. These regions now represent some of the most affordable housing markets around the country, a factor which explains the high proportion of first home buyer participation in these markets. The last time values were this low in Darwin was back in March 2007. In Perth, values were previously this low in April 2006, and values haven't been this low across regional WA since July 2005. Adelaide was the only capital city to avoid a fall in housing values through May, with the Corelogic index rising 0.2% over the month to be 0.4% higher over the past 12 months. Housing values and transactional activity are generally holding firm across Adelaide. Compared with most of the other capital cities, this is actually a reasonably strong result. The median selling time is also held reasonably firm at 43 days. However, vendors have been discounting their price expectations in order to make a sale, with vendor discounting rates rising from 4.9% a year ago to 5.3% in May. Since the federal election, we've seen a variety of outcomes and announcements that are likely to have a positive effect on housing market conditions. The federal election outcome has removed the uncertainty surrounding taxation reform, which should see an improved level of confidence amongst homeowners and prospective buyers, particularly investors. Additionally, now we've seen some certainty around the initiatives announced in the federal budget, a consistent commission structure for mortgage brokers, who comprise around 60% of mortgage originations, and the eventual stimulus for first home buyers in the form of a federal government deposit guarantee, although that's limited to 10,000 participants with at least 5% deposit. That will kick off in January next year. Another positive announcement came from APRA late last month, where we are likely to see the serviceability assessments used to qualify borrowers for a home loan reduced sometime in late June. Dropping the interest rate serviceability test from the current level of 7.25% to a 2.5% buffer above the going mortgage rate will help to improve access to credit and enable some borrowers to obtain a larger loan. One of the factors contributing to less activity in the housing market has been the challenge involved with accessing credit. While there are a variety of other policies that will continue to keep a lid on housing credit, a more practical assessment of borrower servicing capacity is certainly a positive for housing market demand. Another factor that should support housing market conditions is lower mortgage rates. The RBA cut the cash rate by 25 basis points in June. Mortgage rates are already around the lowest level they've been since the 1960s, and we're seeing lenders passing on most, if not all, of the rate cuts through to home loan mortgage rates. Lower interest rates have typically shown a positive influence on housing demand. Importantly, lower rates may not provide the same level of stimulus as what we've seen in the past, due to tighter credit policies, but no doubt lower rates together with lower serviceability assessments and the removal of the uncertainty surrounding the federal election will provide some positive influence over the housing market. While the outlook for the housing market is looking more positive than it was pre-federal election, a variety of headwinds are still at play, especially in the credit space. Although interest rates and serviceability tests are set to reduce, lenders continue to scrutinise incomes and expenses much more intensely. Comprehensive credit reporting is providing lenders with greater visibility around borrower finances and overall debt levels, and progressively lenders are reducing their exposure to borrowers with high debt levels relative to their incomes. We should also keep in mind the reasons why interest rates are heading south. Policymakers are becoming increasingly concerned about the slippage in economic growth, stubbornly low inflation, and sluggish wages growth. Economic growth over the first quarter of 2019 was the lowest since the global financial crisis. The labour market is seeing some cracks emerge, and global trade tensions remain high. If the economy continues to lose momentum, we could see further weakening in labour markets and a continuation of weak wages growth, which will continue to restrain household consumption, which is the most significant contribution to the Australian economy. In closing, there's no doubt policymakers and regulators will be keeping a close eye on the housing market. If we see housing values surging higher on the back of increased stimulus measures, we may see macroprudential or other policy levers being pulled in an effort to provide house price stability, while at the same time supporting an improvement in economic activity. However, the more likely scenario is an earlier levelling in housing market conditions than we previously expected, followed by relatively steady conditions, at least at a macro level. With the housing market changing so rapidly, make sure you're staying up to date with the timeliest updates on the housing market at www.corelogic.com.au.